In this video, I will show you everything you need to understand what Forex trading is. Forex, or the foreign exchange market, is the silent engine of the global economy. Every day, over $7 trillion are traded in this market, influencing prices, economies, and even the cost of your next vacation. But what exactly is Forex? How does it work, and why it's so important to the modern world? In today's video, we will explore the Forex market and its impact on the world, from large institutional investors to small private traders. Trading is the act of buying and selling financial instruments such as stocks, currencies, commodities with the intent of making a profit. It can be done in the short term, that's called day trading, or the long term, that's called investing. The key to trading is speculation on price movements. A trader buys an asset when they believe its price will rise and sells it when they expect the price to fall. This process takes place in various financial markets, including the stock market, Forex, and the commodity markets. Today, we will take a closer look at Forex, the currency market, to understand how it works, who uses it, and why it is so crucial to the global economy. Forex, or the foreign exchange market, is the financial market where currencies from different countries are traded. It is the largest and most liquid market in the world, with a daily trading volume exceeding $6 trillion. Unlike other markets, such as the stock market, Forex operates 24 hours a day, 5 days a week, and is decentralized, meaning it has no central exchange. Trades take place between banks, financial institutions, governments, traders, and other entities. Who are the main participants in the Forex market? The main participants in the Forex market are central banks. They manage monetary policies and influence interest rates and a country's currency. For example, the Federal Reserve in the United States or the European Central Bank in Europe. Governments and financial institutions. Governments and financial institutions, such as hedge funds and pension funds, participate to manage currency reserves or speculate on exchange rate movements. Retail traders. These are individual investors who trade in the market through brokers. Companies. Multinational corporations use Forex for hedging against exchange rate risk in international transactions. Perfect. Before we continue, don't forget to leave a like, subscribe to the channel, and turn on the notifications. Forex market session. The Forex market is divided into different trading sessions that reflect the time zones of the major global financial hubs. The most important sessions are Asian session, that called also Tokyo. During this session, liquidity is relatively low compared to the other session. European session, that also called London, it is one of the most active sessions with high volume of trades. And the last one is American session, that called also New York. This session is very influential, especially during the overlap with the London session, which generates high volatility. Currencies are financial instruments used in the Forex market to exchange one currency for another. Each currency is represented by a 3-letter code such as USD for the US dollar, EUR for the euro, AUD for the Australian dollar, NZD for the New Zealand dollar, CAD for the Canadian dollar, CHF for the Swiss franc, and GBP for the British pound. So, in the Forex market, currencies are always traded in pairs, meaning that when you buy one currency, you are simultaneously selling another. Each currency pair represents a value relationship between the two currencies involved. This system is essential to understand how prices work in Forex and how transactions are determined. So, when you trade Forex, you are buying one currency while selling another at the same time. Let's look at the euro-dollar currency pair. For example, the first currency in a pair is the base currency, in this case is euro, and the second currency, in this case USD, is the quote currency. Let's say you get a quote of euro-dollar as 1.1000. This means for every 1 euro, you get 1.10 of US dollar. There is always an invisible one beside the base currency on the left. So here's what happens when you actually trade currency. When you buy a currency pair like the euro-dollar, or when you go long on the euro-dollar, you are expecting the euro to appreciate, while the dollar depreciates. When you sell a currency pair like the euro dollar, or when you go short on the euro dollar, you are expecting the euro to depreciate while the dollar appreciate. The major pairs in Forex are Euro USD, USD JPY, GBP USD, Audi USD, USD CAD, USD CHF, and NZD USD. All these pairs have one thing in common, which is the American dollar. So let's see what the major pairs are. The major pairs in Forex trading are the most traded and the liquid currency pair in the market. This pair always involves the US dollar as one of the two currencies being traded, since the US dollar is the global reserve currency and the major pairs are strongly influenced by economic and political events in the United States, as well as in other major economies such as the Eurozone, the United Kingdom, and Japan. Instead, the minor pairs in Forex trading are currency pairs that not involve the US dollar. Minor pairs usually represent currencies from economies that are not directly tied to a US dollar, but still have significant global trade. These pairs are influenced by economic events and policies in the countries of the two currencies involved. What are pips? In the Forex, a pip, percentage point, is the unit of measurement that represents the smallest change in the value of a currency pair. In most currency pairs, a pip corresponds to a movement in the last decimal place, which is the fourth decimal. For example, if the euro dollar is sitting at 1.021 and its value gained by 1 pip, it will move to 1.0422. Most currencies are written to the fourth decimal place, with the fourth decimal place representing 1 pip. However, there are some exceptions, such as with the yen cross pairs, that the Japanese yen is often quoted to 2 decimal places. Types of market orders. In the Forex, we have 3 types of market orders: the market orders, limit orders, and stop orders. A market order is an order that is executed immediately at the best available price in the market. When a trader places a market order, they are buying or selling a currency pair at the current market price, without waiting for the price to reach a specific level. This type of order is used when you want to enter or exit the market quickly. Limit order. A limit order is an order to buy or sell at a specific price. Unlike a market order, a limit order will not be executed immediately. The order will only be filled when the price reaches the desired level. This type of order is useful when you want to buy at a lower price than the current market price or sell at a higher price. Buy and sell stop orders. In a trading, a buy stop order and a sell stop order are pending orders that are triggered when the price of an asset reaches a certain level. Here's an explanation of each. Buy stop. A buy stop order is a buy order placed above the current market price. This type of order is triggered when the price of the asset reaches or exceeds the specific level. It is used when the trader expects the price to rise further after reaching a certain level, and is used in a breakout scenario. Sell stop. A sell stop order is a sell order placed below the current market price. This type of order is triggered when the price of asset drops to or below a specific level. It is used when the trader expects the price to fall further after reaching a certain level, and is used in a bearish trend. The role of the broker and leverage. A Forex broker is an intermediary that allows traders to access the currency market and open or close positions. Brokers provide online trading platforms such as MetaTrader 4 or 5, which enable market analysis and trading. Brokers earn through spreads, the difference between the buy and sell price, or commissions. It is essential to choose a regulated broker that ensures the protection of funds and transparent trading conditions. Instead, the leverage offered by brokers to retail traders is a mechanism that allows to amplify potential gains, but also risk, in trading operations. In practice, it allows traders to trade with an amount of money greater than what they actually have in their account. For example, if a broker offers a leverage of 100, it means that for every euro of your capital, you can control up to 100 euros in position in the market. So, the leverage is a double-edged sword, so it is important to use it with caution and have good risk management. Forex market volatility. The volatility in the Forex market is influenced by various economic and geopolitical factors. Interest rates. Central banks' decision to raise or lower interest rates directly impact the strength of a currency. A higher interest rate tends to make a currency more attractive to investors. Inflation. A high inflation rate erodes the value of a currency, while a low inflation rate tends to strengthen it. Economic news. Data such as GDP, unemployment rates, industrial production, or the consumer price index can trigger significant market movements. Geopolitical events. Elections, political changes, or international crises can create uncertainties that increase market volatility. So guys, these were the 10 basic concepts that every beginner should know to understand what Forex trading is. I hope it has been helpful. If you have any questions or want to dive deeper into any topic, leave a comment below and I will be happy to respond. Don't forget to like